the Q&A tab itself. All right. So without further ado, let's welcome Mr. Louis Wong to actually share more about the China Hong Kong outlook and the stock picks.
Thank you. Good morning, everyone. Glad to see you again. Today, I will share with you our Q3 third quarter strategy and stock pick for Hong Kong and China. Okay, let's look at the first half and the second quarter. After experiencing a drastic drop in January, whereby the Hang Seng Index dropped to below 15,000, the market consolidated around 3 months in the first quarter, and then started a rally in late April. During that time, the Chinese government launched a series of supportive policies. For instance, China launched a so-called Project Whitelist mechanism, 白名单, on January 26, aiming at injecting liquidity into the crisis-hit sector, the real estate sector. Under the Project Whitelist mechanism, city governments are recommending to banks residential projects suitable for financial support and are coordinating with financial institutions to meet projects' needs. So investors are concerned about the unfinished, incompleted property projects that will weaken buyers' confidence in property purchase. So this Project Whitelist mechanism aims to not asking the city government to directly lend money to property companies to complete the projects. Instead, they are recommending to banks residential projects. And also the assistance, the bailout is not for company, is project-based. So city governments will decide which residential projects are worth for their recommendation to commercial banks to extend financial support to those projects for completion. So that's the Project Whitelist mechanism. And then the Chinese government also announced that they will issue ultra-long special government bonds to stimulate economic growth. This is to, because we know in the last 2-3 years, tax revenue by city governments have shrunken due to the weakening property market and less land sales. So the issuance of ultra-long special government bonds is to help provincial governments to raise funds for provincial, for local infrastructure investment. So this is to propel the economy by more infrastructure investment. Okay, and then to further boost the property market, local governments have further relaxed property market purchase restrictions. In the past, first-tier cities such as Beijing, Shenzhen, Shanghai did not really relax the restrictions. But this time around, we noticed that even first-tier cities, including Beijing, Shanghai, and Shenzhen, Guangzhou, they all relaxed property market purchase restrictions on both first property and second property, first home purchase and second home purchase. Okay, and the third 9 national regulations, 新国9条, 新国9条, 9 national regulations is already the third announcement. I mean, the third round was ushered in to strengthen supervision and risk prevention and promote high quality development of the capital market. So the Chinese government in the first half of this year, they had done a few things to aimly targeting the property market as well as the capital market, equities market. And the biggest boost to the Hong Kong market is between April and May, the CSRC, China Securities Regulatory Commission, announced 5 measures in capital market cooperation with China that is expected to attract more southbound fund flow into Hong Kong. And since then, since the announcement of these 5 measures of capital market cooperation with Hong Kong, the Hang Seng Index rallied from below 15,000 to a peak of 19,700 in late May. Okay, yes, as a result, the Hong Kong market rally in the second quarter. However, at the backdrop, China's economy remains sluggish, as shown by economic data. The 3 growth drivers for GDP are still remain sluggish and show slow growth. Okay, so performance of the Hang Seng Index and the Tech Index. Hang Seng Index was up 7.1% in the second quarter. Actually, the rally was achieved mainly between late April and early May, when the CSRC announced the 5 cooperative measures with Hong Kong. After then, the Hang Seng Index retreated from 19,700 to recent low is around 17,350. Yet it, you can see from TA's perspective, technical analysis perspective, the Hang Seng Index still managed to hold above the 2 key moving averages, namely the 100-day moving average, which is the black line, the black one, and the red line is the 250-day moving average. And we saw a rally in the last 2 days. Yesterday, the CSRC announced a new measures to prop up the Asia market. That is the restriction on short selling that helped spur the Asia market rebound, staged a strong rebound yesterday. Okay, and the Hong Kong market also followed yesterday. Okay, but the Hang Seng Tech Index fared less well. It was up only 2.2% in the second quarter and was down 5.6% in the first half. You can see the Hang Seng Index was up 7.1% in second quarter and 3.9% in the first half. Despite the correction in the last 2 months, the Hang Seng Index was still up around 4%, 3.9% in the first half. Yet Tech Index was down 5.6% in the first half, except for a few big tech stocks, big tech companies such as Tencent, JD.com, and Bilibili. Those are few strong ones. Others fared rather badly in the second quarter, including NetEase, Alibaba, and Kuaishou and Baidu. Okay, but I didn't show here that is another index. Actually, that's the one of the bright spots in the Hong Kong market in the first half. That's the China Enterprise Index, 国企指数. China Enterprise Index was up 9.8% in the first half, outperforming the Hang Seng as well as the Hang Seng Tech Index. Actually, one of the reasons for Hang Seng Index to be able to rise, to return a positive performance in the first half is very much contributed by strengths in China enterprises, especially state-owned enterprise, which is one of the main themes, investment themes, which we believe will continue for the rest of the year. China state-owned enterprise and the so-called Chinese special valuation, 中特股. Okay. Okay. As for the Asia market, actually, it did not fare so well. Shanghai Composite Index was down 2.4% in the second quarter and also down 0.3% in the first half. Quite flat, you can see. It is quite flat. But like the Hong Kong market, it posted a rather brief rally between April and May, whereby the Shanghai Composite Index rose to close to 3,160, and then it fell to hold about 3,000. It went to drop below 2,900, and recently seems to stabilize around below 3,000. Okay. Shenzhen Composite Index fared worse, underperformed the Shanghai Composite Index, because Shanghai Composite Index, there were more state-owned enterprises included in the Shanghai Composite Index, and relatively outperformed Shenzhen Composite Index, which of which most of the constituents there are more private enterprises among the constituents in the Shenzhen Composite Index. Okay, so this is the Shenzhen Composite Index. Okay, now admittedly, the Hong Kong and China market are still facing quite many headwinds and rather few tailwinds. Okay, so we'll go through what are the headwinds the Hong Kong and China market are still facing. First of all, geopolitical tensions, and then super election year also lead to uncertainty, mounting depreciation pressure on renminbi, and China experiencing a slump in consumer sentiment. Okay, that leads to further weakening of economic growth. Okay, geopolitical tensions, currently there are four key concerns. First one is cross-strait is closer to us. Cross-strait, the Taiwan Strait. Cross-strait tensions have escalated since the election of Taiwanese leader William Lai Ching-te, branded a separatist by Beijing. Okay. And then Gaza peace talks at deadlock, but over the last few days, there seems some good news coming out from this peace talk between Israel and Hamas, and that's why oil prices are coming down as there are higher hopes of both sides reaching peace agreement to stop fire between them. But at a time, Iran may also, there's worry that it may also involve Iran, because Iran warns Israel against full-scale attack on Lebanon, and that would complicate the situation with Iran being involved. Okay, the third area is Ukraine. Ukraine still rules out any compromises in its war with Russia, and Russia accuses the West for hindering the resolution of the conflict in Ukraine. And in this Ukraine war, China is also involved because the West believe that China is behind Russia, is providing military support or support of military weapons to Russia. So this is also a complicated situation. And then also closer to us is in the South China Sea. We see escalating tensions between China and the Philippines. Okay, so there seem a lot of uncertainty, headwinds, geopolitical headwinds we are facing, especially in Taiwan, in the Taiwan Strait and the South China Sea. Okay, super election year now. The second half will be more focused on the West. Recently, you have the election in France and the UK, and in November, it will be the much awaited election in the US. Yet it may affect the relationship, how it will affect the ties of the West, between the West and China, because of new emergence of new political leaders in the West. First, in France, far-right politics National Rally, the RN, has won a resounding victory in the first round of parliamentary elections, which many people believe they are going to win also in the second round of election. However, it came third in the July 7 election, behind Macron's centrist Ensemble coalition in second, and in first place was a 3-week-old left-wing alliance in the New Popular Front. So it's quite intriguing in the political scene in France. If you follow, the France election, so expectation of ruling party, which is right-leaning, suddenly becomes left-leaning, ruling party that is more left-leaning. However, because there's no party that is able to form a parliamentary majority on its own, so France is heading for a very turbulent coalition government. And how does it affect China and Hong Kong stock market? I think it should be more positive than negative, because originally the president of the RN, the National Rally, Marine Le Pen, who was tipped to win the election, but ultimately did not. She has vowed to stand up against China in Indo-Pacific and feared a mega alliance between Russia and China. She's more hostile or less friendly, let's put it that way, to China. Now she fails to win the election, may be a positive to the China and Hong Kong stock market, because the new government may pose less threat to China, maybe less hostile to China. Okay, the U.S. election, we had just watched the debate 2 weeks ago. So Donald Trump's lead in the 2024 presidential race has widened after President Joe Biden's fumbling debate performance, and there are advocates that the Democratic Party should replace to change their president candidate. Okay, according to a CNN poll, 3/4 of U.S. voters say the Democratic Party would have a better chance holding the presidency in 2024 with someone other than Biden. Okay, so if Trump is elected, he may be more aggressive in suppressing China in terms of tariffs in the trade area and also in technology. And Trump has threatened to impose 60% tariffs against China if elected. Okay. In the UK election, also there's a big change because the Labour Party has won a landslide victory, ending 14 years of Conservative rule. Labour leader Keir Starmer has replaced Rishi Sunak as Prime Minister with strong parliamentary powers, majority in the Parliament. New Foreign Secretary David Lammy said before the election that Labour's strategy towards China was to compete, cooperate, and challenge with China. It seems he's more friendly, less hostile towards China. But these 3C, the so-called his 3C strategy, there's the factor of competition, cooperation, and challenge. But which one, what will the focus? More cooperation or more competition is still uncertain. He proposed a slogan, Britain Reconnected. He wants to improve the ties with not only China, but also with the Eurozone. After Brexit, it seems to do more harm to Britain than He believes that the UK should actively engage in comprehensive cooperation with China. They will work to improve the UK's ability to understand and respond to the challenges and opportunities brought by China. And Labour has pledged to begin an overhaul of China policy via an audit to be launched during its 100 days in office. So we'll wait and see what is the UK's new China policy. Okay, but we do expect that the new government will adopt a more balanced and coherent China strategy to replace the muddle that has marked London's approach to Beijing over recent years. It will be more, it will be a clearer, more balanced and coherent China strategy. So it should be more favorable to China. Okay. Another headwind is mounting depreciation pressure on renminbi. First of all, the U.S. Federal Reserve latest forecast is that it will cut interest rate only one time this year. But the chance of a rate cut in September is rising, especially following the release of recent economic data. CPI data came in lower than expected last night, US CPI. So the chance of a September rate cut has risen to 85% now from around 70% before the release of the CPI data. So this will, if the US is able, the Fed is able to cut interest rate earlier, it will help lessen the pressure on renminbi to depreciate because of the interest, the gap between China and the US. Besides that, as China's economic data and inflation are in a soft patch, we expect China will need to cut interest rate further to spur spending and investment. Yet this is hindered by the US. China can't move before the Fed cut interest rate because a further widening of the interest rate gap will put more pressure on the renminbi. Okay. It will increase depreciation pressure on renminbi as well as renminbi denominated assets, including equities. Okay. Now China is experiencing a slump in consumer sentiment, which is quite widely reported in the press. China's factory activity shrank for the second consecutive month in June. This is official manufacturing PMI, while the non-manufacturing sector expanded at a slower pace. Data from the National Bureau of Statistics, 国家统计局, show that China's official manufacturing PMI stood at 49.5 in June, flat with the figure in May, and the second consecutive month that the PMI stands below 50, which signifies contraction. Okay. The non-manufacturing PMI came in at 50.5 in June versus 51.1 in May, moving closer to 50, the dividing line between expansion and contraction. However, the Caixin China PMI fared slightly better. Caixin China manufacturing PMI came in at 51.8 in June, up 0.1 points from May, and growing at the fastest pace since May 2021. Yet, it is worth to note that the Caixin China Services PMI eased to 51.2 from 54, quite a big drop, from 54 in May to 51.2 in June, marking the lowest reading since October 2023. And the sub-index for expectations on production and operations fell to a record low since December 2019. So the optimism of entrepreneurs in the manufacturing sector also prominently weakened, with them being worried about the pressure of the downward economy and the fierce market competition. Okay. According to Chinese data provider Xinten, because last month was June, the 618 shopping festival, which is one of the key events among e-commerce operators in China, but rather disappointing figures coming out from this year's 618 shopping festival. The total GMV or sales during This year's 618 shopping festival shrank 7% year-on-year to 742.8 billion yuan, which is the first decline over 16 years, the first decline over 16 years. And by comparison, the 618 shopping festival posted sales growth even during the epidemic. Even during the epidemic, GMV sales also see sales growth. But now after the epidemic, the reopening of the economy, the GMV, the sales posted 7% decline this year. Very quite disappointing. This showed that consumer confidence remained downbeat amidst a number of unfavorable factors, such as a high youth unemployment rate and the prolonged real estate crisis. Okay, financial workers in China are facing pay cut. There are reports that many bank employees have their pay cut by 40% or even more, and they have to return to their employer the bonuses that they have received in the past, and even layoff. I missed the word off, and even lay off as financial institutions grapple with a slowing economy and pushes for common prosperity, 共同富裕. Okay, so these factors add up, cause a slump in consumption and consumer spending. Okay, having gone through all the headwinds, let's come to some of the tailwinds. People's Bank of China, the PBOC, announces treasury bond borrowing operation with a number of financial institutions with several hundred billion renminbi of medium to long-term government bonds currently available for lending. I'll explain later in detail what is the objective of this treasury bond borrowing operation by the PBOC. And then upcoming this month, a key event to watch is the Chinese Communist Party third plenary session of the 20th Central Committee, 三中全会, from July 15 to 18, to discuss the issue of further comprehensively deepening reform and advancing Chinese modernization. Okay. The PBOC announced plans to conduct treasury bond borrowing operations with primary dealers in the open market in the near future. I'll explain briefly how this works. Because China's sovereign bonds have performed strongly this year, with yields hitting record lows, because of more fund flow into the bond market, more demand for bond pushes up the bond prices, and lowering bond yields. And why we see more fund flow into the bond market is because the weakening economy and also the volatile stock markets push savers into fixed income safe haven instruments. Chinese people now dare not buy property, dare not invest in the stock market, so and bank deposit rates are not high enough, so a lot of the money go into fixed income, go into especially government bonds, sovereign bonds. Under this treasury bond borrowing operation mechanism, the PBOC will borrow the medium and long-term bonds on an open-ended, unsecured basis and sell them depending on market conditions. This is a new tool that will help the central bank to control the flow of credit and market yields, thus stabilizing long-term interest rates and mitigating interest rate risk. Now, the problem with the bond market in China is because there's big demand for bonds, so pushing up the bond prices and pressurizing bond yields. So by borrowing bonds and sell those bonds on the secondary market will increase the supply of bonds that will help bring down bond prices and also pushing up the yields. And this will help push government bond yields back up to what the PBOC considers an appropriate level. And this move is also favorable to Chinese banks because it will help enhance the fixed income investment return for financial institutions. Not only banks will benefit, but also insurance companies holding fixed income will benefit from higher higher bond yields. Okay, so this is one of the latest move by the PBOC to stabilize the bond market. Okay, the third plenary session of the 20th Central Committee of the Chinese Communist Party will be convened from the 15th to 18th July, that is next week. And the theme of the third plenary session this time, is studying issues of further comprehensive and in-depth reform. It's more about economic reform and also promoting Chinese-style modernization. The third plenum is widely considered one of the most important events in China's political agenda and is usually focused on various aspects of reform in the country. The market expects that major economic policies will be launched after the third plenary session, which will address a few things, namely the current sluggish consumer sentiment, economic downturn, domestic real estate, and local government debt problems. So hopefully there are new policy initiatives to address these issues that's impacting the Chinese economy. Okay, our third quarter outlook, for the Hang Seng Index, we saw there's recent support for the Hang Seng Index around 17,400. There's rather strong support near the 100-day and 200-day the 100-day and 250-day moving average. That's around 17,400. If it breaches the support of these two moving averages or drop below 17,400, the next support would be 16,800, somewhere here. The peak seen in March and April now, which is the resistance level, now becomes, after being breached, now becomes the support level for the Hang Seng Index. And the key support would be around 16,000. That's where the rally started. The April rally started from 16,000. So this is the key support for Hang Seng Index: 17,400, 16,800, and 16,000. Recent resistance is 18,100, around here, the 20-day moving average, which is lies, at the highest position. Today, the Hang Seng rally more than 300 points, again touching 18,100. Yeah, but we reckon that the next resistance will be around 18,500. Yeah, this would be the next resistance level, and the key resistance will be 19,000. Okay. First, we'll talk a bit about the sectors we are downbeat on, the bearish sectors, because in the past, I remember some Singapore investors holding Hong Kong land. They asked about the outlook of Hong Kong land. Hong Kong land is one of the largest office property landlords in Hong Kong. So we expect some those sectors related to the Hong Kong local economy will perform weakly, okay? Namely the residential property sector and also the office property sector. US interest rates have been rate cuts have been repeatedly postponed, which led to Hong Kong's borrowing costs remaining high because the Hong Kong dollar is pegged to the US dollar, and our interest rate also follows the US interest rate. Although the Hong Kong government's cancellation of all spicy stamp duty, including additional stamp duty, buyer's stamp duty, and ad valorem stamp duty, 撤辣, the cancellation of all these spicy stamp duty will lower the threshold for home purchase and help stimulate property market transactions. Yet Hong Kong's housing supply remain abundant in the next few years. So we only saw a brief increase in property transaction in April and the early part of May after the cancellation of those stamp duties in late March, okay, or in early April. But subsequently, property transactions have, the transaction has calmed down, and we see property prices continuing dropping. Now it has dropped to the 2016 level. Okay, so that means property, those who bought property in the last 7 or 8 years did not make any profit when they sell the property at the current price. Coupled with the impact of the immigration waves, more Hong Kong people emigrating overseas, and weakening Chinese economy and renminbi, less fund flow from China into Hong Kong, Hong Kong may see lower demand for property. Okay, so we are still downbeat about the property, the residential property sector in the next 2-3 years. I think this will take time for the supply to be taken up. Okay, Hong Kong developers are slashing prices of the new property projects. They are talking about, I think, Cheung Kong is one of the most aggressive one in slashing property prices of the new property projects by 30 to 40% to drum up sales with adversely impact. Which will adversely impact their profitability and dividend payout. A lot of the property developer stocks in Hong Kong, their appeal to investors is the dividend yield. So with profitability and dividend payout being weakened, it would put pressure on their stock price. Okay. And in terms of office property, the overall vacancy rate of Grade A offices now rose to 13.5% at the end of May, mainly due to the new completions. In May, there are two main big big project completion. One is Cheung Kong Center 2, in between near Central. Is between the Admiralty and Central, Cheung Kong Center 2, which is redeveloped after from the Hutchison Tower, Hutchison Center, and KTR 31350 in Kwun Tong, Kowloon East, both completed in May. As a result, Central and Kowloon's vacancy rate rose to 12% in Central and 18.5% respectively. So the average vacancy rate at the end of May of Grade A offices stood at 13.5%. Central is 12%. Kowloon even more serious. The vacancy rate, because there's more supply of new completions, 18.5%. As a result, rents fell for the 25th consecutive months, with notable decreases in Central, Hong Kong East, Tsim Sha Tsui, and Kowloon East. These are the areas which has the most abundant supply. According to Savills, there is projected to be an additional office supply of 8 million square feet between 2024 and 2027. So we are not out of the woods yet. The office property market is not out of the woods yet, because more office supply is expected in the next 3 years, with an average annual take-up. Average annual take-up is only 1.3 million square feet net. So office vacancy rates are projected to reach 17% by the end of 2027. Okay, if demand, this is the worst case scenario. Okay, comes to the worst case scenario, if demand follows a more volatile trajectory resembling the average annual take-up of only 0.5 million square feet, much less than the 1.3 million projected take-up rate. Net, this is witnessed from 2018 to 2022 during the epidemic period. Office vacancy rates are expected to surpass 20% by 2027. Wow, very scary, very worrying. So we are also not we are also downbeat on the office property market. And retail and catering are also the sectors that will suffer and continue to be under pressure. I mean, Hong Kong retail and Hong Kong catering. Hong Kong retail sales declined 11.5% year-on-year in May and 6% in the first 5 months this year, attributed to changes in the consumption patterns of visitors and residents and the strength of the Hong Kong dollar. Now, more Hong Kong people are going north, going to Sunshine and the Greater Bay in the weekend and to spend their weekends there. And those with longer holidays will tend to go to Japan, Thailand, or Taiwan to and spend their holiday. Also because of a strong Hong Kong dollar that will make them, increase their purchasing power in overseas. And then for visitors from China are spending less compared as they did in the past. More pain is in store for Hong Kong's retail market amid structural changes that have led to residents spending more overseas and online, while fewer mainland Chinese visit Hong Kong, and they are splurging much less than in previous years. Okay. As retail rents remain high, the Hong Kong Retail Management Association chairwoman Annie Xie Yo An Yi has called on landlords and shopping malls to X rents by at least 30%. So despite in the previous slides, you mentioned that office property rent have dropped 25th consecutive for 25th consecutive months. Yet retail rents remain high. So there's a call from the industry that retail rent should be cut by at least 30% so as to alleviate merchants' financial burdens. Okay. What are the sectors we are upbeat, bullish sectors in? Just now I mentioned one of the main theme and also the few bright spots in the Hong Kong market are Chinese SOE, state-owned enterprise. In late November last year, Yi Huimen, chairman of the Chinese Securities Regulatory Commission, the CSRC chairman, stated that efforts should be made to explore a valuation system with Chinese characteristics, 中特股, so that the market can play a bigger role in allocating resources. It aims to improve the valuation as many SOEs used to provide high dividends and stable profitability. They're stronger than the private enterprises, and also they tend to receive more support from the central government. They used to pay high dividends, but they have long been undervalued and overlooked by equity investors. So it's imperative to construct a valuation system so as to generate a higher valuation for these SOEs. The sectors with significant valuation gaps are mostly concentrated in banking, construction, telecommunications, petroleum and petrochemicals, and coal industries. Okay, key features of this so-called China special valuation stocks, 中特股股票, they have high dividend yields, generally not less than 5%, generally more than 5%. Stable and steady growth in performance, strong resilience to risk, capable of enduring economic cycles. And stocks are still in a severely undervalued state, with notably either low price to earnings ratios. Most of them are trading at 4-5 times PE and less than 1 time P/book. For instance, most of the Chinese banks, state-owned Chinese banks, are trading at 0.4 times P/book and yielding 7 to 8% yield. So still very attractive in terms of valuation. Okay, so one of our stock pick is Bank of China. Among the 4 state-owned banks, we prefer Bank of China. Bank of China is the first commercial bank in China that has engaged in integrated operation with businesses covering investment banking, asset management, insurance, direct investment, leasing, consumer finance, technology finance, among others, which enable BOC to provide enterprise clients with comprehensive financial services. As at end June 2023, at a total of 532 overseas branches in 63 nations and regions, with the number of overseas branches, proportions of overseas staff to total staff to geographical coverage, ranking first in the banking industry in China. So it's the more internationalized player among the 4 state-owned or the 6 state-owned banks in China. If you include also the postal banks, Postal Saving Bank of China and BOCOM, okay, there are 6 state-owned Chinese banks. So in 2023, you can see the all the financial indicators improve, show steady improvement. For instance, its operating income increased by 6.42%. Its net interest income increased by 1.58%. Net fee and commission income increased even faster by 5.31%. And PPOP increased by 3.68%. Profit after tax increased by more than 4%, and profit attributable to shareholders of the bank increased by 2.4%. So overall, across the board, increase in different financial indicators. So this is a peer comparison with the other 5 state-owned banks, namely ABC stands for Agricultural Bank of China, BCM is BOCOM, Bank of Communication, ICBC is Industrial Commercial Bank of China, PSBC is Postal Savings Bank of China, CCB is China Construction Bank. So the red line, you see, in terms of revenue growth, it outperformed the other 5 state-owned banks, with ICBC posting negative growth in revenue. And the CCB also, that's why the share price lagged behind last year. But in 2024, we also noticed that ICBC and CCB are picking up because the valuation gap with BOC has widened. So people also look at CCB and ICBC because in terms of valuation, now they are more attractive. I mean, at the time, they were more attractive compared to Bank of China, because Bank of China has outperformed them in terms of share price this year. And then revenue breakdown, it has a more sound revenue structure. Non-interest income ratio, the higher the non-interest income ratio implies less reliance on interest income. Okay, BOCOM is the highest with 38% of revenue coming from non-interest income, including commission and fees, 38%. It is the highest among the 6 state-owned banks. Second is BOC, 25% of its revenue comes from commission, non-interest income. And then ICBC was 23%. China CCB, it should be CCB, 20%. ABC and Postal Savings Bank of China are less than 20%. That means, which implies they are more dependent on interest income. If the the NIM, the so-called net interest margin, goes down, they will be more affected by the contraction in NIM. But of course, on the contrary, if their NIM goes up, they will benefit more. On the right-hand side, this is the fee income breakdown in the first half of 2023 for Bank of China. So 25.4% comes from agency business, 17.1% comes from settlement and clearing, 13.4% comes from card businesses, 12% from credit commitment, 11.6% from consultancy, and 8.2% from custody and other entrusted businesses. Income from foreign exchange and buying and selling price difference, 5.6%. Okay, and other accounted for 6.9% of its fee income. So besides having a rather high non-interest income ratio, Bank of China also shows a more balanced fee income structure. Okay, rising share of time deposit in line with banking industry. The higher ratio of time deposits would mean more stable cost of funding for banks, so they can lend out to borrowers. At end of June 2023, Bank of China's share of demand deposits in its total deposits was 42.5%, so quite balanced. Slightly less than 50% of its total deposits are demand deposits, which is a middle level in the industry, with the personal corporate demand deposit rates at 37.4% and 52.4%. So corporate demand deposit will be also more stable compared to personal demand deposits. So it has a higher ratio in corporate demand deposit that will imply more stable funding costs for the bank. Okay. So on the right-hand side, this is a comparison of demand deposit ratio, the proportion of demand deposits in the total deposits. So the highest is Postal Bank, Savings Bank of China. The highest is Construction Bank of China. 46% is demand deposit. Then BOC is in the middle, 43%. Okay, Postal Saving Bank only 30% are demand deposit, which means 70% are savings deposit. So the depositors can take out money anytime, and which implies less stability for their lending because of higher ratio of savings deposit. Okay, in terms of corporate demand deposit, Bank of China 52%, both CCB and ABC 56%. Again, this corporate demand deposits, Postal Bank of Saving has the highest, 66%, and then personal demand deposit ratio, also BOC is in the middle, very stable, 37%. Everything in the middle in the industry. Okay, when you talk about bank, we also look at the NPL ratio, non-performing loan ratio. BOC's NPL ratio is better than the average and also declining over time. So this one, the red line represents the NPL ratio. Now is it has dropped to 1.2%, around 1.2% from about 1.4%, from close to 1.5%. But of course, balance of non-performing loans are also growing. It's only that their loan portfolio, the loan book, also grow quite fast. So the NPL ratio came down instead of rising. Okay. On the right-hand side is the NPL ratio of the big six, the six state-owned banks at end third quarter 2023. They are more or less very close with only PSBC, Postal Saving Bank of China, having the lowest NPL ratio, below 1%, only 0.81%. Others come in within the range of 1.2 and 1.4%. None of them are higher than 1.4%. So Bank of China is 1.27%. Also the lowest besides PSBC, the lowest among the other 5 state-owned banks. Okay, but it has a lower provision coverage ratio than its peers. The coverage ratio, the highest Postal Saving Bank, you can see the blue line here, 350% coverage, provision coverage of their potential bad debts. Okay, the second highest is ABC, which is close to 300%. Bank of China is around 160, 170. The mandatory provision coverage ratio is 150. So all the state-owned banks are quite healthy in this sense. Their provision coverage ratio are all higher than the mandatory provincial coverage ratio. But the too high may not be a good thing, because they provide too much, over provide. So I think Bank of China and also the other one is BOCOM. They are more realistic in doing provision for their non-performing loans. Okay. Solid and improving capital and liquidity position. This is the equity ratio. Okay, Bank of China, the CET1 cap ratio is 12%, so it has improved from below 12% to 12%. Other banks also see its other capital ratio, the Tier 1 capital ratio and also the total capital ratio all show improvement in the last half year, showing about one percentage point improvement in total capital ratio, and 0.21 percentage points improvement in Tier 1 cap ratio, and 0.39 percentage point improvement in CET1 cap ratio. Okay, the share price, you can see it outperformed the market, and after hitting a recent high of around 3.73 Hong Kong dollars after paying dividend, after the ex-dividend, now it's in a consolidation mode in the last 2 months. So we reckon that it's a good entry opportunity during its consolidation correction after the recent rally from in the first 5 months this year. 345, we reckon that 345 would be an appropriate entry price level. Okay. The other SOE that we have picked is CNOOC AA3. It is the largest producer of offshore crude oil and natural gas in China, and one of the largest independent oil and gas exploration and production companies in the world. The company mainly engages in exploration, development, production, and sale of crude oil and natural gas. For the first quarter, this is the financial performance of the company in the first quarter. Total revenue was 111.4 billion. This is shown in million, but in billion is 111.4 billion yuan revenue in the first quarter, representing 14.1% increase compared to the same period last year. Profit attributable to equity shareholders of the company was 39.7 billion yuan, growing 23.7%, much faster rate than the growth in revenue. And basic earning per share EPS was 0.84 yuan, also growing by 23.7% year on year. Weighted average return on net assets was 5.79%, increased by 0.54 percentage points compared to the first quarter last year. And the company, the total paid a total of final dividend and interim dividend of 1.25 Hong Kong dollars per share last year, tax inclusive. So at the current price, its dividend yield is about 5.6%. Okay. Oil and sales gas and realized price in the first quarter. Revenue from sales of crude and liquids was 78.2 billion yuan, representing a year-on-year growth of 23.6%. Revenue from sales of natural gas was 11.7 billion, an increase of 7.9% year-on-year. And in total, revenue from oil and gas sales amounted to 89.9 billion yuan, up 21.3% over last year. And then crude and liquid realized price, average realized price equivalent per barrel was $78.75 in the first quarter this year, up 6.2% year on year. However, natural gas, because of the drop in international natural gas prices, the average realized price was down 7.7% to $7.69 per MCF in the first quarter this year. Okay. All-in cost was well controlled and reduced by 2.2% from $28.22 per barrel to 27.59 per barrel. This is the cost, the all-in cost, which include DD&A, operating expenditure, dismantlement, SG&A, taxes, and other income taxes. So the main drop is in DD&A decrease mainly due to the combined effect of changes in exchange rates and production mix. Okay, OPEX remains stable. Okay. For CNOOC, one of the bright spots is strong production growth continues. In the first quarter this year, the company's net oil and gas production was 180 million barrels of oil equivalent, an increase of 9.9% year on year. Okay, so it benefits from higher production of oil and gas and also higher average realized price in crude oil. The growth was mainly from both from overseas and also domestic growth. Overseas growth mainly driven by production ramp up in two places, Guyana and Canada. Okay, so 16.9% growth in production overseas, faster growth compared to 6.9% growth in domestic China. Growth in China mainly attributable to increased production from newly on-stream oil and gas fields. Okay, in the first quarter, it has made one new discovery and 4 successful appraisals of oil and gas structures. This one is in Qinhuangdao and Bohong, Bozhong, the north, the Rimbo Huanbohai area of China. Okay, and there's a new discovery, the Bluefin project. Okay, now here's one key project, the 36-1 oil field secondary adjustment and development project has been put into production, and other new projects are progressing smoothly. So we expect stable growth in its oil and gas production going forward. Okay, business outlook. EIA forecasted global liquid fuels consumption averages 102.9 million barrels per day in 2024 and 104.3 million per day in 2025. So still projecting higher fuel consumption, liquid fuel consumption in the next 2 years, especially non-OECD Asian countries, particularly China and India. They will consume more liquid fuels. This will drive global liquid fuels demand growth. And the ongoing recovery and positive trajectory of China's economy supports the demand for oil and gas. The offshore oil and gas serves as a significant growth driver for oil and gas production in China. So compared to PetroChina and CNOOC, they are more onshore operators. So their oil fields are more located in onshore China. But for CNOOC, it has more offshore oil fields. So that would be one of the significant growth driver compared to PetroChina and CNOOC. That's why we favor CNOOC to PetroChina and CNOOC. OPEC Plus production cut to persist, poised to support elevated oil price. The IEA expects a shift from surplus to slight deficit for the global oil market in 2024. So they will lend support. We do not expect crude oil prices to rally, to have a big rally. It will remain stable, and that would benefit CNOOC. We expect sustained output cuts and geopolitical tensions will support elevated oil prices, which could fully benefit CNOOC. Okay, like BOC, Bank of China, its share price outperformed the market. So we now at only 10 times PE and yielding more 5.5. I think more than that. I think more than yielding 7% yield. We believe there's still upside. So a good entry level would be around 22 Hong Kong dollars. Okay, near-term target will be 24. Mid-term target will be 26. Okay. Another sector we are bullish about is consumer plays with heavy domestic demand. Now we have to qualify. Only consumer plays with heavy domestic demand would outperform. Because China's GDP only expanded 5.3% year-on-year in the first quarter of 2024, with domestic consumption now contributing 73.7% to economic growth. So domestic consumption is playing an important role in GDP growth in China. Continued urbanization is the main driver of China's sustained consumption resilience. By the end of 2023, approximately 66.2% of the total population in China lived in cities, still lower than the average level of around 80% in developed countries. It is estimated that every 1 percentage point increase in the urbanization rate will translate to an additional 200 billion yuan of consumption demand. And besides that, China has vowed to expand domestic demand and promote steady growth in consumer spending this year. Okay, but unlike a few years ago, when you see the upgrades in, 消费升级, investors are buying more luxurious goods, high-end products. Now, with the downgrade, 消费降级, I think those the consumer staples with heavy domestic demand will stand out, will benefit compared to the discretionary consumer discretionary place. So our stock pick is Wong China Holdings 151, ticker 151. The company was established in China in 1992. It was listed on the Singapore Stock Exchange in 1996, but was subsequently delisted in September 2007. It was then relisted this time on the Hong Kong Stock Exchange in 2008. Wong is engaged in the manufacturing, distribution, and sale of rice crackers, the Wang Mi Bing, dairy products, Wang Zai Niu Lai, and beverages, snack foods, and other products. While most of its operations are primarily located in China, it also exports to the US, Canada, Southeast Asia, and Europe. So it also has an overseas market. Okay, it has lately announced its financial results for the financial year till the end of March this year. Revenue increased by 2.9% to 23.5 billion yuan. Operating profit increased more by 15.7% year-on-year to 5.609 billion yuan. Operating profit margin also improved 2.7 percentage points to 23.8%, and net profit increased 18.4% year-on-year to close to 4 billion yuan. Net profit margin also improved by 2.2 percentage points to 16.9%. Earning per share was 0.3365 yuan, up 18.7% year-on-year. Its ROE and ROA also showing healthy ROA, ROE, and ROA with 25% return on equity and 14.9% return on assets. Okay, business outlook, we believe that there's still big potential for the snack market in China. There's a huge snack market in China. The market size of snack food industry in China is expected to reach 1.15 trillion yuan in 2026. And the market is very fragmented. So we expect further consolidation of the fragmented market, which will benefit the big players. Okay, data shows that the CR4 is the top four players of domestic snacks is only 9.7%. They account for less than 10% market share. While the figures in the United States and Japan are as high as 38% and 23.8% respectively. So we expect more consolidation resulting in the big ones like Wong garnering bigger market share over time. Okay, it has a differentiated brand strategy and brand positioning, and is very innovative in launching new products. The company launched differentiated sub-brands targeting different consumer groups for mothers, babies, toddlers, the elderly, women, and fitness enthusiasts. So it's very client segmented. Okay, leveraging on its R&D capability, the company has continued to introduce innovative products and enrich new flavors. Example, they have launched Dongchi and double layer QQ gummies, 双层 QQ 糖. Okay, as I mentioned earlier, it has a overseas market. Its overseas revenue achieved a mid to high growth rate in financial year 2023. Revenue growth was prominent in the Asian, American, and Oceania regions. 5 overseas subsidiaries in Vietnam, Thailand, Indonesia, Germany, and North America have been established, and the group has been exploring business models and approaches that are suitable for the local market according to the characteristics of different economies and countries. Okay, so different consumers in different countries will have different tastes for snacks and its products. So it will launch the localized products targeting the local consumer group. Its factory in Vietnam has officially commenced production which will facilitate the cultivation of the Southeast Asian market. I think ASEAN is one of the growth impetus for Wong in the next 3 to 5 years. Its share price was quite flat, stable and flat, unlike the share price of BOC and CNOOC. Yet after the announcement of its full year results, because of better than expectation, its share price rallied from around 4.1 Hong Kong dollars to 4.9. So we reckon that below around 465, between 450 to 465 would be a good entry level. Okay. The other one consumer play that we believe would benefit from huge domestic demand will be Xiaomi. Xiaomi is an innovative technology enterprise focusing on the construction of high-end smartphones, internet TV, and smart home ecological chains. Now, plus one more product, that is EV, smart EVs. The company's main businesses include smartphones, IoT, Internet of Things, and lifestyle products, internet services, and smart electric vehicles. Okay. In the first quarter this year, its revenue increased 27% year-on-year to 75.5 billion yuan. Gross profit increased even more by 45.2% to 16.8 billion yuan. Gross profit margin improved 2.8 percentage point to 22.3%. Operating profit dropped by 37.6% to 3.683 billion yuan, and operating profit margin dropped by 5 percentage point to 4.9%. Net profit saw only 1% drop to 4.17 billion yuan, and net profit margin remains stable around 5.5%. Okay. Business highlights is smartphone segment. According to Canalys, in the first quarter of 2024, global smartphone shipments to increased by 9.8% year-on-year. So after 3-year downturn, the global smartphone market start to show some recovery in the first quarter this year, and we believe the increase will pick up in the second half or even in 2025 because of AI handphones. It will entice more consumers to change their handphones to replace their existing handphones with AI handphones. The company has maintained its number 3 global smartphone shipment ranking with a 13.8% market share. In the field of IoT and lifestyle products, revenue from IoT and lifestyle products was 20.4 billion in the first quarter, an increase of 21% year-on-year, and gross profit margin reached 19.9%, hitting a record high, notably up by 4.1 percentage points year-on-year. According to Canalys, in the first quarter of 2024, the ranking of their TWS earbud shipments rose to number 2 globally and number 1 in mainland China. In terms of internet services, revenue from internet services reached 8 billion yuan, hitting a record high, an increase of 14.5% year-on-year. The internet user base continued to expand. Their monthly active users, MAU, globally and in mainland China both hit record highs. The global MAU of the smart TV reached 67.6 million, an increase of 11.6% year-on-year. Then last but not least is smart EVs. Smart EVs was officially launched in March this year, the Xiaomi SU7 series, which was quite well received by the market, with prices starting at 215,900 yuan to 245,900 and 299,900 different models. Okay, they have received significant market interest in and strong demand for the Xiaomi SU7 series. As of April 30, 2024, the cumulative locked-in orders for the Xiaomi SU series reached 88,000 vehicles. So now they are not so worried about orders. They actually have received strong response in terms of orders. Now the main concern is their production capacity, whether they can catch up with the orders. Now they aim to increase their production capacity to 100,000 vehicles per year. Okay, so they are on the track of increasing their output, the production capacity. In the first quarter, sorry, we have gone through this. Business outlook, we are optimistic about Xiaomi's development of smart EVs. With branding advantage, we expect this new business segment will increase the company's revenue significantly in the long term. Okay, coupled with incorporating AI into their business operations, aligning AI with user scenarios to empower their human times car times home strategy. 人车家 they have this strategy of 人车家. In smartphones, deeply integrate AI with Xiaomi Hyper operating system, providing functions such as real-time translation, text-to-image generation, AI portrait, etc. In smart EVs, they will incorporate AI into the research, development, and application of autonomous driving and smart cabins. In the smart home sector, Xiaomi HyperMind, the cognitive hub of smart homes, will significantly enhance user experience. That's how they incorporate AI into their business operations. Okay, share price also outperform the Hang Seng, the broad market. But after hitting a recent high at $20.35 in late May, its share price retreated to now around $16. So we reckon that at the level of $16 level would be a good entry price. It represents more than close to 20% correction from the recent high. Okay, so that ends my presentation here, and then we'll go on with the fireside chat and Q&As.
All right. Thank you, Luis, for the interesting and insightful session. All right. So now we'll be moving on to the Q&A and the fireside chat. All right. Regarding the Hong Kong market itself. All right. So maybe we'll start with the Q&A. Some of the questions that's upvoted, the highest one. All right. So I think we do have some upvoted questions. So if you have any questions, do feel free to post them on the Q&A tab. All right. So for the first one, I think they are more interested in one asking on the very recent uprun today. I think due to the yesterday the US market rally, so I think it actually conveyed over to the Hong Kong market performance today. So maybe Louis got follow any of the recent recent outperformance of Hong Kong market. Is there any view on it, or is it due to the upcoming meeting event in China?
Yeah, I think that's the main cause, because let's look go back to my slides. Yeah, I want to show you the price chart of the Hang Seng Index. It's actually can you close the first? Yeah. Can I have the mouse? Yeah. After hitting peak of around 19,700, is trading in for the last 1 month is stuck in a tight range between 17,500 and 18,300. Actually is trading sideways. But of course, expectation of more supportive policies from the third plenary session, and also expectation of rate cut by the Fed in September will help improve investor sentiment. So, but we'll wait and see if there are more solid policies announcement from the third plenary session, okay, that will be conducted between 15 July and 18 July. So next week lah. Technically, from the technical analysis point of view, the Hang Seng Index has to rise above 18,500 to confirm that it will start an uptrend again. Otherwise, it's still on a, now it's from May to June, through June, it's we reckon that this is a correction after the strong rally seen in between April and May. And then it may be approaching the end of the correction, and it has to, the Hang Seng Index has to rise above and hold above 18,500 to confirm that is on another uptrend again. Okay, so the first first index level, it will be 18,500, and then 19,000 will be a confirmation that the Hong Kong market is heading for an uptrend in the second half. So let's see. And then I think one more indicator to watch is the market turnover. In the last few days, only except yesterday and the day before yesterday and yesterday, market turnover in Hong Kong climbed back above 100 billion Hong Kong dollars. Before that, a few days, the daily market turnover was less than 100 billion. So another indicator to watch is the pickup in market turnover, which implies more fund inflow into Hong Kong to confirm that are we entering a new uptrend? We're going to heading for a new uptrend in the second half. So you need also two confirmation on the index level. I am looking at 18,500 and 19,000 to confirm that we are entering an uptrend. And then on the turnover side, we need more higher, we need to see a substantial increase in daily turnover, say to at least 120 billion a day would be a healthier level, fund level. Okay, yeah, can you show the...
Okay, so I think there's also another question on the China banks itself. All right, so right now the China bank outlook, there's one question on the China bank outlook, as well as whether or not the China bank are considering to have two dividends a year instead of the upcoming only once a year. So maybe you can comment on this question.
Okay. But actually, it's more psychological, a feel-good impact. The actual impact will depend on whether Chinese banks will increase substantially their dividend payout. I think a more important indicator is the payout ratio, whether they up their payout ratio. At the moment, I think it's lies at 30%. So we'll watch if they can raise it to 35% or even higher. There's a payout ratio. But whether to pay interim or not, interim dividend or not, is only it mean to investors who are more concerned about cash flows. They will feel good if they receive interim dividend payment. At least they receive dividend payment twice a year instead of once a year. But in terms of absolute amount, actually, it is dictated by the payout ratio. But we are overall still upbeat on the banking sector with stable financial performance. And also the central government's efficacy to pay higher, more dividend to shareholders. Okay, yeah.
Okay, thank you for the reply on that. I think previously some of the clients also remember your recommendation on the JD counter. So I think there's some questions on the JD Logistics and Baidu update as well as the JD overall update lah. So maybe you can comment on the JD itself.
Okay. JD have two, three companies listed in Hong Kong, but among all the listed companies within the group, our top pick is still JD.com 9618 in comparison to JD Health 6618 and JD Logistics 2618. Okay. We understand that the e-commerce market in China is facing very intense competition. Yet JD.com seems to be doing well in view of the competition from Alibaba and Pinduoduo, and also new entrants such as Douyin and Kuaishou and Bilibili. And now it's embarking upon a strategy of more merchandise, self-merchandise goods that will help improve its. First of all, it will be more flexible to offer different merchandise to its users, less dependent on third-party suppliers, and also the profit margin will also improve because they for third-party suppliers they only receive commission, which is a rather low. I mean, because of competition, they are seeing lower commission sharing from third-party suppliers. So 9618 is one of the tech companies that we are still upbeat about. Besides Tencent, the other one would be JD.com. Yeah.
All right. Thank you very much on that. I think there's also a few questions.
I saw the question from Huan Ji. He asking why it's not moving given the current market condition. Actually, I think not moving is at least it's not dropping. If you look at share price of NetEase, Kuaishou, and even Baidu, the share price has and Alibaba as well. The share price has dropped quite substantially recently. So not moving, being able to hold above the current price level already demonstrate its resilience to the corrective market mode. Baidu, okay. JD Logistics now the portion of business from its parent company is coming down, so it's healthy overall. But I won't say, because the logistic part is facing competition from other. They are from Cainiao, and also the express delivery players in China. There are a few of them. So there's pressure on the ASP, the average selling price. JD Logistics, we are only neutral. Among the three companies, JD, we have a long call. We are bullish on JD. For JD Logistics, our stance is neutral. And for JD Health, we are a bit bearish. So this is our investment rating for the three JD group of companies. And for Baidu, I think it's an interesting company because it has the AI component. It is one of the among Chinese companies, one of the early takers of AI. And it has its own big model, AI model. And then in terms of autonomous driving, it's also making good progress in autonomous driving in China. I think the rally in the last 2-3 days is due to reports on its robo-taxi, Apollo robo-taxi, Luobo Kuaipao. There's making
remarkable progress in certain cities in China, namely Wuhan. In Wuhan, it has already more than 400 taxis being put into operation, and 55% of its orders it operates the hailing robo taxi hailing platform. And in April, in the first quarter, 55% of the orders are for autonomous driving, robo-taxi with no drivers. Okay, and April it rose to 55%. So it expect next year it will rise to 100%, which means it will be more appealing to passengers, because I read in the news report that the taxi fare is much cheaper compared to those with human drivers. Okay, let me show you the yeah, in Wuhan, a 10-kilometer ride in a self-driving robo-taxi costs between 4 and 16 yuan, whereas a regular ride hailing service costs between 18 and 30 yuan. So it is how many? 70% cheaper than the taxis with human drivers. So it's believed that this is autonomous driving business segment will, at least in Wuhan, will show profit next year, will turn around next year. So I think it's an undervalued company, Baidu, with two catalysts for rally. One is AI, the other is autonomous driving, is undervalued. And now market seems to realize its hidden, the hidden growth. So the share price rally quite substantially over the last 2 days. And we do expect recovery in valuation going forward. Okay.
All right. Thank you, Louis. I think there's a few questions on Link REIT. Maybe we want to address on Link REIT itself. I think on the REIT sector, I think overall, so previously it was a very popular investment target. And of course, recently the REIT's performance was not very good over the last 2 years. But maybe now with the interest rate environment moderating, and China maybe lowering rates might be a potential investment area again.
Yeah, I think if you go back to these few slides, that do not bode well for the REIT sector. The retail segment is impacted by weaker spending. I explained why consumer spending decline in Hong Kong because of changes in the pattern. I think it's more a more worrying sign. And then vacancy, because Link REIT, besides the operation of shopping malls, recent years it has also invested in office properties, and higher vacancy rate, rising vacancy rate also does not bode well for Link REITs. And it is dividend yield is also not exceptionally attractive compared to other high dividend yield stocks. So in view of the gloomy outlook or other dismal outlook, our investment rating for the REIT sector now is still sell, or we have a bearish stance on the REITs sector.
Okay, I think also next we do have some questions revolving around AIA in terms of why are they so weak and whether or not they will be performing well, as well as your own personal outlook on insurance company. So not only AIA, but maybe also on Ping An as well.
Yeah, I think in the first quarter, all the three insurance companies, international insurance company, non-Chinese insurance company listed on the Hong Kong market, namely Manulife, Prudential, and AIA, they all posted very good first quarter results in terms of new business and value, new enterprise value, and new enterprise value growth, and new enterprise profit margin. But the concern is investors are worried about the outlook that they may not see as good growth in business new enterprise value as they did in the first quarter, and that lead to a sell-off in the share price. Despite the company announcing that they will increase the buyback, the share buyback plan from $10 billion to $12 billion. So they top up by $2 billion. So I think that like Baidu is a bit oversold, and as once investors worry about the slowdown in new enterprise value growth, is clear that is not turn out not to be that bad, and I think there's room for the value. I mean, also recovery in value, revaluation potential in for the company, for AIA.
Okay, so I think we answered on that. I think maybe just one comment also was that on your investment recommendation in terms of topics, right? So we did mention some of the the good points about them. Maybe the question is actually on whether or not there's any investment risk, or like maybe some headwinds to actually look out for those companies that you recommended.
So sorry, I don't get your question. Can you repeat?
Meaning for the topics, let's say, for example, your CNOOC, and also like Xiaomi, and some of the topics that we have mentioned at the end of the session, with the end, right? What is the investment risk? Like, what is the headwinds that the company might be facing?
Or the headwinds these companies are facing, right? Okay. For Bank of China, I think so far the property market issue, the debt problem, have not impacted very much, have not been demonstrated in the financial results yet. Whether this will lead to more bigger provision for non-performing loans or write-off and cause the NPL ratio to increase again remains to be seen. But now it seems that the Chinese government they have announced, as I at the beginning of my presentation today, the Chinese government have done quite a few, taken a few big steps in addressing the property market issue, say by recently we also noticed that in last month up to in May, the transaction in both primary and secondary market in Beijing and Shenzhen and Shanghai had shown strong rebound in transaction numbers, in transaction volume. So that at least shows that after the relaxation of those restrictions, home buyers are coming back to I mean, we see re-emergence of home buyers. So headwind for banking stocks would be the asset quality. But at the moment, we don't see apparent deterioration in asset quality. But we need to watch closely whether there's any signs of deterioration of asset quality. Okay. For CNOOC, I think the production side is quite stable. We are less worried about the the production, whether it's I mean, any drop in or any our projection of future production output will see a big shortfall. We don't expect that. I think the main headwind would be crude oil prices. Because among the three petrol company, oil companies in China, CNOOC is the most sensitive to crude oil prices. So if the higher the crude oil prices would be more favorable to CNOOC. On the contrary, if crude oil price come down, it will not be in favor of CNOOC. So I think one of the headwinds is crude oil price. Okay. As for Wong, okay, last year and this quarter, up to this first quarter this year, it sees a better gross profit margin, not because of higher demand for its product. Actually, the demand for its product is quite stable. So I think two headwinds. One is demand slacken. For its products will demand slacken. And the other one is raw material price. And for Wong, palm oil price, sugar, I mean, all the raw material price. If raw material price for the last 1 year, it sees higher gross profit margin because of lower raw material price. So if raw material price go up again, it may pressurize its gross GPM, its gross profit margin. So one of the major headwind we anticipate would be the change in raw material price, and then demand for its, whether there's a slackening demand for its products. Okay, for Xiaomi, the headwind on the handset side, we are a handphone side, we're not too worried because the general belief that is AI PC will trigger a replacement cycle that will help the growth of AI smartphones shipment in this year, in the second half of this year and next year. But EV would be one uncertainty. At the moment, is quite, I mean, well received by the market, but competition among other car makers is also very intense, to be honest. So it's facing very intense competition from other car makers in China. Okay.
Okay, thank you on the headwinds sharing regarding the top picks. I think they'll be appreciated by clients interested in taking on position on the top picks that was shared today. There's questions on like some recommendation of ETF that investors can look at to trade in the Hong Kong market. So I think one of them specifically asked on the view on the Hong Kong tech index itself, or maybe any other ETFs that you find suitable to track the Hong Kong market.
Okay. There is a new launch of state-owned enterprise ETF, high dividend ETF, just this week. I think that's one. If investors are upbeat about, I mean, share the same view of share our view on the state-owned enterprise high dividend 中特股 investments theme, then they may take a look at this Becerra SOE high dividend ETF. Wait. It's it launched by Becerra Asset Management Company, which is one of the top 5 asset managers in China. So it's known as China Reform Hong Kong Central SOE's High Dividend Yield Index ETF. It began trading just this week, making this the first investment product in the market dedicated to the theme of central state-owned enterprises, offering domestic and foreign investors a new tool to assess Chinese SOE assets. So it saves the trouble for investors to in picking stocks. You can invest in the ETF that tracks the CSI China Reform Hong Kong Connect Central SOE High Dividend Yield Index. This index includes nearly 50 industry-leading central SOEs in sectors like energy, communication services, industrials, utilities, and healthcare. And with a focus on high dividend yields, this ETF offers global investors a convenient way to invest in China's central SOE. As of December 2023, the average dividend yield of the top 10 constituent stocks in this ETF was about 7.86%, providing strong cash flow support and long-term earnings potential. So this is one newly launched ETF that may provide good investment opportunity for investors.
I think also maybe there are some questions on the Kuaishou itself, or maybe since we are going to touch on Kuaishou, maybe you can also share the view on the Bilibili at Meituan as well.
Okay. At the time, their 直播电商带货becomes a growth driver, but now even 直播带货 in China also becomes increasingly competitive, and with the main business segment, both Kuaishou and Bilibili are very much related to consumption, such as advertisement and e-commerce, and other business segments such as online games and the video 视频, the cost for operating those is also going up. But Kuaishou, I think the share price is oversold. So with the news of share buyback plans, its share price rebounded recently. But between Kuaishou and Bilibili, our preference is Bilibili. In terms of the business performance in the first quarter, we think Bilibili outperformed Kuaishou. Okay.
Okay, I think there's also some questions on regarding the tech sector for Hong Kong, the semiconductor sector, meaning on SMIC. So the client question is whether or not SMIC have any hope of challenging TSMC perhaps in the future, like based on the current trend. Of course, short term I think is a bit hard, but maybe in the long term future, does it have any position that if potentially can challenge TSMC in that field?
I would say it is an uphill battle because in terms of technology now, as TSMC is already producing 3 nanometer and 5 nanometer chips, and is in talks of launching 1.5 nanometer chips, whereas SMIC is still the product majority of its product is 45 nanometer and 28 nanometer, with 40 nanometer accounting for less than 20% of its product mix. So I think it's not easy. It's an uphill battle for SMIC to catch up with or to challenge, if you use the word challenge, TSMC. Because it is also facing the headwind from US sanction in developing more advanced chip products. Okay, so that will become the stumbling block for SMIC. Among the between Hua Hong Semiconductor and SMIC, we prefer Hua Hong because Hua Hong is not in the battle of more advanced strategy. It's in not, I mean, in the size. It's in the bigger Jingyuan producing is on an what do you call advancement in terms of from 6-inch to 8-inch, 10-inch. Now is moving towards 12-inch, bigger Jingyuan, and now it's reported that its capacity utilization has top 100% or even exceeding 10%. So it's reported that it will be able to increase prices for its chips in the second half by at least 10%. So between SMIC and Hua Hong Semiconductor 1347, we prefer 1347 compared to 981, and also less political headwind for Hua Hong.
Hello. Right. Thank you. I think we have a few questions also. I think on the traditional one that we have not touched on a lot yet is on Alibaba. All right. So I think quite many questions still ongoing on Alibaba, whether or not it will go up to above 100 Hong Kong dollar, as well as maybe what is performance like, perhaps more of like within AI. Because we mentioned Baidu just now, but Alibaba is also one company that is trying to be of AI side. Is there any outlook on this aspect?
I regret to say that the chance for Alibaba to go back to $100 in the short term is quite slim, a slim chance, because it's facing very intense competition in the e-commerce, which is still its core business. In a few of its core businesses, namely e-commerce and cloud service. At one time, it was its fast growth new business, but now its cloud business is also under threat from the Chinese telco operators, namely China Mobile, China Telecom. They are grabbing market share from Alibaba in the cloud service business segment. So that doesn't leave too much growth catalyst for Alibaba. And then interestingly, yesterday Alibaba price went up more than 3% because of Ma Yun, Jack Ma, returning to China and showing face in appearing in the headquarters in Hangzhou in Alibaba. But of course, there's speculation that last time, 100 days ago, his last visit to Hangzhou was followed by a management reshuffle at a very high level. They replaced the chairman and CEO of some of their key core companies. So whether yesterday's speculation was whether the appearance of Jack Ma will imply there's again some reshuffling, management reshuffle in the near term. But to us, we see too frequent management, high-ranking management, senior management reshuffle may not be good to the company, because it may undermine the stability in management as well, and also business strategy planning. I think that's also one of the, compared to Tencent, the management change is a bit too more frequent than other tech companies like JD and Tencent. There's one negative factor on the Alibaba share price.
Thank you, Luis. I think we have covered quite a lot of questions and we are reaching the end of the session. So maybe we look through the the questions again. Remaining, we still have a lot of questions. We regret that we cannot answer all of them. But we
I
maybe
may
look
add one
at
point. Sorry,
yeah.
I may add point for those who have downloaded Poems 3 mobile 3 app. Actually, you can join our community group. You go to the community group in Poems app. Choose Zhen Huang Shifu. My people call me Master Wong in Hong Kong. So I have a personal community group called Zhen Huang Shifu in the community group, where you can also find on your Poems mobile app. Then you can join this community group. Once you have joined this community group, you can ask me questions about Hong Kong or China, or you can share your views there, and then I can interact with you on the app. Okay, so there's also one of the avenues that I mean, keep up my update on the Hong Kong market to Singapore clients, Singapore investors.
Yes. Thank you, Louis, for the presentation and interactive Q&A. So like Louis mentioned, we do have the investing community groups. Later on, there'll be a link on that. So let me just end the session first, where we have come to the end of the webinar today. And we'd like to thank everyone for spending this morning to afternoon with us. And I hope everyone have a great lunch in a while. Right, for the session just now, we'll be uploading the recording on the PhillipCapital YouTube itself. You can view the recording at your own time in the YouTube page once it's uploaded. We do also have other interesting webinars and seminars going on almost every other day. You can feel free to go to our education page on the homepage to view our full list of the free webinars that we have. Also, we would like to have a chance to ask for your feedback. You can fill the survey in this QR code. Share your experience with us so we can improve for the future. All right. Of course, we have this ongoing promotion for Hong Kong market. So where if you trade Hong Kong market now, there's categories for existing and also new clients that trade Hong Kong market, then you can actually stand a chance to win a lucky draw. So the lucky draw is for clients with valid buy contracts. So if you purchase or you buy Hong Kong counters through Phillip, through the Poems account that you have with us, you can actually have a chance to win these lucky draw prizes. You can find out more details in our promotion page itself. So next, we also have a session on 1 to 2 p.m. on the Japan market, okay, which is upcoming. Like what Louis mentioned just now, we also have the investing communities group where you can feel free to gain access to the full research reports on not only Singapore but also like what Louis mentioned is that you can also join the Hong Kong community groups, which I think a lot of questions that we have not been able to answer. If you do have a very strong sense of interest to understand what is the answer to your questions, do actually post them on the Hong Kong community group by joining it. You have to use the Poems 3.0 app for this community group. So do download the Poems 3.0 app to use it. All right. So once again, thanks everyone for joining us, and we hope to see you again later at 1 p.m. where we're discussing on the Japan market. All right. Thanks everyone for joining.